Okay, good day everyone. No? For today, we're going to have a discussions about bond analysis and portfolio management strategy. So, bond analysis and portfolio management are essential components of uh, investment today. No, especially on uh, the components of investment strategy. No? Particularly for investor no, seeking steady income and risk mitigation. Bond analysis involves evaluating fixed income securities no, like government or corporate bonds no, to determine their potential return and risk. No? So key factors and bond analysis include interest, no, rate sensitivity, no, credit quality, no, yield, maturity, and issuers financial stability. So analysts uh, assess no the factors to determine whether a bond fits the investor's objectives and risk tolerance. So evaluating bond fundamentals, no, investor can estimate the income stream no and principal protection, providing insights into the bond's value in different economic conditions. So an important aspect of bond analysis is assessing interest rates no, as bond prices inversely correlate with interest rates no. When interest rates rise, no, bond prices typically fall, no, which can negatively affect bond portfolio value. Duration, a measure of a bond's no, sensitivity to interest rate changes, helps in quantifying the risk. Let's say, for example, a bond no, with a longer duration will be more sensitive to interest rate no, changes than one with a shorter duration. So credit risk is another factor no, as it reflects the likelihood of the issuer defaulting on payments. High yield bonds offer better returns but come with higher credit risk, requiring careful analysis to balance potential rewards with risk. And to give us more details about the topic, let us all welcome our presenter this afternoon. Go ahead, ma'am.
Thank you po, Doc. Good afternoon, everyone. So, my presentation is about bond analysis and portfolio management. So, learning objectives, identify key bond characteristics like coupon rate, maturity, and yield, and recognize different types of bonds. Learn how to calculate and interpret important metrics like current yield and yield to maturity. Understand the main risk of investing in bonds. Learn the different strategies for managing portfolios and risk mitigations, and assess portfolio performance using key benchmarks and return matrix. So, this one, yung definition ng bond, yung components ng bond, tas yung types of bonds, na-discuss na to ni Sir Miguel. So, parang recap na lang. So, what is bond? An investment that pays a fixed rate of return through interest or dividend income. It's like a loan that you buy and sell. You lend money to a borrower, so you as an investor is a creditor, parang ganon. So, yung borrower, it can be corporation, municipality, or government. And you get interest and your money back later. So, yung feature ng bond, yung face value, ito yung principal amount or yung original amount na ininvest in the bond. So ito rin yung amount na ibabayad or i-repay ng issuer or ng borrower at maturity. Coupon rate, so ito yung annual interest rate na binabayaran on the face value of the bond. So yung coupon payment frequency naman, so yun yung how often na binabayaran yung interest payment. It can be annually, semi-annually, quarterly, monthly. Then maturity date, ito yung date when the bond issuer repays the principal amount or yung face value to the bondholder. Then credit rating, so ito yung measure ng issuer's creditworthiness. So a higher credit rating generally means lower risk of default. So yung pinaka mataas na higher credit rating, which is mentioned by Sir ni Doc Abante last class, is yung AAA. So pag AAA, it indicates na extremely low risk of default. Then yung lowest credit rating naman from triple C, double C, and C. So yun yung mga bonds na very speculative with a higher risk of default. Then issuer, ito naman yung mismong borrower, either corporation, municipality, or government. Then yield, ito yung total return an investor can expect to earn from a bond. So, it can be yung interest payment, yung price appreciation ng bond, depreciation. So, yun yung yield. Then, types of bonds. So, ito, na-discuss na din. Government bonds is issued by state or local government to raise funds for various projects or to finance deficits. They are generally considered safer than corporate bonds due to the lower risk of default. Corporate bonds issued by corporations to raise capital for business operations, expansions, or acquisitions. They offer higher interest rates than government bonds to compensate for the increased risk of default. The municipal bonds issued by the state and local government to finance public projects. They often offer tax advantages, making them attractive to investors in higher tax brackets. So why it offers tax advantages? Kasi usually yung municipal bonds ay bonds, ang fina-fund niya yung mga sustainable na projects like for environmental or social development. So, yun yung kaya minsan or madalas meron siyang tax advantages or tax exemption. The zero coupon bonds sold at a discount to their face value and do not pay periodic interest. Instead, the investor receives the full face value at maturity. Then yung difference ng purchase price and yung full ng face value, yun na yung mismong parang implied na interest earn ng investor. Then, to compute or key metrics to analyze bonds, so meron tayong current yield. So, in current yield, it helps investors assess the income generated from a bond or other fixed income security related to its current market price. So, yung current yield nakakatulong sa investor to evaluate yung return on investment at a specific point in time, especially sa mga bonds na binibenta or binibili in a secondary market. The formula to compute current yield is annual coupon rate or interest payment. Annual coupon payment or interest payment divided bond price. So, for example, if an investor buys a 6% coupon rate bond with a par or face value of 10,000 for a discount of 9,000, the investor earns an annual interest income of 600. That's 10,000 times 6%. So, yung current yield will be 600 pesos divided yung purchase price ng bond na 9,000, which will be 6.67%. So this current yield ng in our first example means that yung investor nag-earn siya ng relatively higher than the initial coupon rate ng bond niya, which is yung 6%. So meron siyang parang excess return na 0.67% bukod sa income na na-earn niya na dividend na equal to 6%. Then if pagka naman yung bond is binili at a premium, or like in our second example, an investor purchased a bond at a premium of 11K. So mas mataas yung binayaran ng investor or yung cash out niya sa pagbili ng bond kaysa sa face value na 10K. So then yung current yung interest income naman is the same pa rin na 600. So ang mangyayari niyan, mas maliit yung magiging current yield niya kasi mas malaki yung nilabas niyang pera, which is yung 11K. So it will be 5.45%. So ang key concept in current yield, a higher current yield kasi is will usually provide a higher return, pero meron din siyang kaakibat na interest rate, higher interest risk or higher risk because so itong type ng ano na to ng mga bonds na merong high yield, mas better lang or mas okay lang siya sa mga tawag dito mga investor na merong diversified portfolio. So sila yung mas ma-incline sa mga risk or changes. So bakit kailangan malaman yung current yield ng bonds? So first, of course, para ma-assess yung income ng investor. So nakakatulong yun para yung ma-assess ng investor yung income nila if yung na-receive ba nila na bond is mas if yung marireceive nilang bond will relatively to what they would pay for is mas mataas parang ganun. Then in investment comparison naman, nakakatulong yan for investor para sa decision making nila kung like kung yung bond ba nila is magpo-provide ng mas mataas na expected return. And also nakakatulong din yung current yield to compete para malaman yung risk, ma-assess yung risk, and also maintindihan pa yung mga market dynamics like yung factors like yung changes in supply demand, yung economic conditions, and yung in terms naman of innovation and technology. Then another key metrics for bond analysis is yung yield to maturity. Other term, redemption or book yield. So ito naman, kinukompute nito yung total return an investor can expect to earn if they hold the bond until maturity. It takes into account the bond's price, coupon rate, time to maturity, and any accrued interest. So the formula is C. Ito yung interest or yung coupon payment plus yung quotient ng face value ng security minus present value or price ng security divide D. Yung time, ito yung years to take the security to reach the maturity. Then, yung numerator, divide lang siya sa quotient ng face value plus present value divide 2. So, for example, there's a bond on a market price na 850 pesos and that bond comes with a face value of 1,000. On this bond, yearly coupons are 150 pesos. The coupon rate for the bond is 15% and the bond will reach maturity in 7 years. So, ang yield to maturity will be 150 na yearly coupon plus yung 1,000 na face value plus yung market price na 850 divide 7 years, then the denominator would be 1,000 plus 850 divide 2. So ang YTM ng example natin is 18.53%. So sorry. So in our yung lumabas yung animation. Pero, bale, ang interpretation lang ng 18.53 means na yung investor, if nag-purchase na ng bond at current market price na 850 and hinold niya yung bond na yun at until 7 years, which is yung maturity, then ang may expect niyang return will, or annualized return will be 18.53%. So that's why yield to maturity. Then, another key metric is yung computation ng duration. Duration is a measure of the sensitivity of the price of a bond to a change in interest rates. So, in duration, ang assumption nito is yung price and interest rate changes have a linear relationship lang. So this type of or this metric na duration is ginagamit lang siya for bonds na merong small fluctuation ng interest rates. So para lang doon lang siya pwedeng gamitin or mas okay kasi ang assume nga niya is linear relationship lang. Hindi niya ina-accommodate yung iba pang other factors na risk or changes. So, ang concept in duration, pag longer duration, it is more sensitive to interest rate changes, exhibiting greater price volatility. Pag shorter range naman, it is less affected, resulting in more stability in their price. So, we can compute yung duration using two, which is yung Macaulay duration and yung modified. So, in Macaulay duration, it calculates the weighted average time until a bond's cash flow are received. So, ito yung pinaka-formula ng Macaulay duration. So, using this formula, we can calculate yung Macaulay duration lang using a scientific calculator, statistical calculator, pero we can manually compute naman. So, ito yung example. So, assume you have a 3-year bond with a face value of 50,000, an annual coupon rate of 5%, and a yield to maturity of 4%. So, to get yung Macaulay duration, need muna natin i-compute yung cash flow per year. So, in our example, ang cash flow per year is 2.5. So, yun yung 50,000 times 5%. In year 1, 2.5. In year 2, 2.5 again. Then, in year 3, 2.5 plus yung 50,000 na face value ng bond. Then, once we know na yung cash flow per year, computin na natin yung present value ng cash flow. So, in year 1, 2.5 divide 1.04 raised to 1, which is 1, because kasi year 1 pa lang. So, ang year 1, ang present value is 2,403.85. Then, in year 2, raised to 2 na siya since second year na. So, ang present value is 2,310.43. Then, in year 3, yung present value for 2.5 and 50,000. So, it will be 46,632.57. Then, once na-compute natin yung present value ng cash flow per year, compute naman yung weighted present value ng cash flow per year. So, to compute lang yung weighted present value ng cash flow per year is times lang siya sa cumulative years. So, in year 1 times 1, so same pa rin. Then, year 2 times 2, So it will be 4,620.86. Then year 3 times 3, 139,897.71. Then once nakumpita natin to, mako-calculate kunin na natin yung parang summation ng year 1 to year 3 ng PV and weighted PV. So in weighted present value, ang summation niya is 146,922.42. Then sa sum of PV, it will be 51,346.85. So to compute yung Macaulay duration, yung simplified formula, if manually i-compute siya, will be sum of weighted present value divides sum of present value. So in our example, yung Macaulay duration nun is approximately 2.86 years or 2 years and 10 months. So interpretation, so if an investor plans to hold the bond for a period close to its duration na 2.86 years, they are more likely to be protected from the interest rate fluctuation. So yan. Then if you as an investor wanted mo malaman yung percentage change ng sensitivity ng price to interest rate fluctuation, you can further compute yung duration using modified duration. So ito, extension siya ng Macaulay duration, which so bali yung kinocompute dito is yung percentage change in a bond's price for a 1% na yield. So ang formula, Macaulay duration divide 1 plus yield to maturity divide n. Yung n, ito yung number of coupon periods per year. So continuation lang ng previous example. So yung sa previous example natin, yung Macaulay duration is 2.86 years and yung yield is 4%. So for example, yung interest nitong example natin is annually compounding. So to compute modified duration, 2.86 divide 1 plus 0.04 divide 1. So yung modified duration will be approximately 2.75%. So in our example, yung 2.75%, it tells how much a bond price will change if interest rates go up or down by 1%. So if yung interest rates go up by 1%, then yung bond price will approximately drop by 2.75%. Then conversely, pag bumaba yung interest rate ng by 1%, then yung bond price will increase by 2.75% approximately. So yun yung sa duration. Then another key metrics is convexity computation ng bond. So ito naman, nirepresent nito yung rate at which the bond's durations changes in response to changes in interest rates. So this one, unlike sa duration, ginagamit yun for bonds na merong small fluctuation in interest rate. Ito namang convexity, ginagamit to for bonds with a large or significant interest rate fluctuations. So ito yung formula to compute convexity, and nag-research ako pero hindi ako makahanap ng parang hindi kailangan ng scientific calculator. So bali ano na lang, bibigyan ko na lang yung parang concept ng kung ano yung result ng ng convexity. So bond with higher convexity values are less sensitive to interest rate changes, offering lower interest rate risk. Bond with lower convexity values are more sensitive to interest rate changes, exposing investors to higher interest rate risk. So bale, pag high yung convexity, yung investor, they don't lose much value when rate rises. Pero if interest rate falls, they gain more. So pagka high convexity, yung investor, na-feel nila na more secure yung holdings nila sa bond kasi they won't be affected kahit change pa significantly yung interest rates kasi nga high convexity. Then pag low naman, yung investor lost a lot of value quickly if interest rates go up and then don't gain as much when interest rates go down. So for this one, pag short-term bonds, yung mga term na 1 to 3 years, ang usually or typically low convexity yon, so often around 1 to 5 convexity. Then pag medium term bonds, yun yung 5 to 10 years, convexity niya is ranging from 5 to 10, 5 to 15 na convexity naman. So medium convexity yung level nun. Then for long-term bonds and zero coupon bonds, yun yung mga typically na merong higher convexity. So yung convexity niya ranging from 15 to 30. So and yung term ng bond are 20 years and up. So yun yung sa convexity. Then risk factors in bonds, ito naman medyo na discuss na rin ni Sir Miguel ata. Then interest rate risk, yung first factor ng risk factor in bond. Interest rate risk is a potential change in bond price due to fluctuations in market interest rates. Then yung credit risk naman, it's the risk that a bond issuer may not be able to meet its financial obligations. Then inflation risk, it is a possibility that the purchasing power of bond returns may be eroded by rising prices. Reinvestment risk, this is a uncertainty surrounding the interest rates at which investors can reinvest the cash flow received from their bond holdings. So ano yung uncertainty na sinasabi dito? Ito yung mga like yung mga economic changes in economy like inflation, increase ng or change ng unemployment rate, pwede ring change sa monetary policy, so yung mga ganun. Then liquidity risk, potential difficulty in buying or selling a bond in a secondary market. Then duration and maturity risk, this is sensitivity of bond price to changes in interest rate. So parang related din siya dito sa interest risk. Then economic market conditions, this the impact of economic and market conditions on bond risk premium. So yung mga, it can be yung kunyari, merong economic recession or merong mga geopolitical events na nangyari sa dalawang countries. So pwedeng yung mga investors maghahanap sila ng bonds na merong mas na mataas na na premium or na return kaysa sa mga short term na bonds and kaysa sa mga normal na long-term bonds. So maghanap sila ng asin yung mataas na return para maka-earn pa rin sila kahit na merong nangyayaring currently na economic problems sa country, parang ganun. Then ito naman, second topic, portfolio management naman. So what is portfolio management? This is a strategic process of selecting, diversifying, and managing a collection of investment with the goal of achieving specific financial objectives. Portfolio composition, it can be cash, can be alternative investment like real estate, private equity, cryptocurrency, insurance. So yun yung mga alternative investment. Then it can be bonds and it can be stocks. Then different portfolio management strategies. So on the basis of activity, it can be active portfolio management or passive portfolio management. In active, ang goal niya is to outperform or i-beat yung market or a specific benchmark. So ang key characteristic nun, regularly buying and selling of asset, the deep market analysis and research, higher fees due to frequent trading and management effort, and higher risk but also potential for higher returns. Then sa passive naman, ito naman, ini-aim lang niya to mimic or to match yung market performance or overall market return. So, ang key characteristic, fewer trades. So, fewer trades lang siya. So, lower management fees, focus on long-term and stable, so it will, and also to earn stable returns, lower risk as it aims to track the market rather than beat it, and commonly involve index fund or ETFs. Yung index fund yung type of mutual fund na may consist of baskets of different securities na designed to mimic yung performance ng specific market o tinatawag na mga passive investment. Then yung ETF or yung exchange traded funds, ito naman yung mga stocks or securities na traded on stock exchange mismo. Then another portfolio management strategy in terms of discretionary, ito naman if yung investor is meron siyang hinar na portfolio or portfolio manager na mag-handle ng investment niya. So in discretionary portfolio management, ang ano dito is yung portfolio manager is meron siyang full control over the investment decisions like yung and also investment decision, executing trades and adjusting the portfolio ng client. So kahit hindi niya na-need ng approval ng investor to make that decisions or adjustment sa investment portfolio ng client. Then non-discretionary, ito naman, advisory service lang yung binibigay ng portfolio manager. So, ang pwede na lang gawin is magbigay ng advice and recommendation. Then yung investor na yung bahala or kung ano yung final decision niya, kung anong gagawin niya dun sa mismong investment niya. So, then, meron din ng iba't ibang risk strategy to mitigate risk naman ng portfolio. So first yung diversification. Ito yung investing in a diversified pool of asset like stocks, bonds, so halo-halo siya to para ma-spread yung risk across asset classes. So like for example, if yung nyari yung sa investment portfolio mo meron kang bond doon, tapos mataas yung risk niya, sobrang taas na risk niya. Tapos meron kang stocks na mataas yung risk, yung bond mo mataas yung risk, ang baba na return. Tapos yung sa kabila, mababa yung stock mo, mababa yung risk. Then mataas yung return, so mag-offset lang yung risk, mag-offset lang yung high risk mo. So overall, parang hindi siya masyadong masakit, parang ganun. Kasi mamimitigate mo kasi ah, marami kang asset in a investment portfolio mo mismo na magkakaiba yung level ng risk and return. Then as another risk mitigation is asset allocation. So ito, strategic and tactical balancing between stock, bonds, and other assets. So for this one, alam ko na i-discuss natin to ni Sir Kai before yung asset allocation. So bale, uh, ang recap na lang. So in future in terms of time horizon, strategic asset is focusing on long term, while in tactical it is short term. Then and in terms of focus, strategic maintaining a fixed allocation, while sa tactical involved in actively adjusting the allocation since nga short term lang yung investment. Then risk, in strategic, it is low risk, while tactical, high risk. Then in complexity, strategic is less complex, and in tactical, it's more complex. Then in terms of management, in strategic is passive since it focuses on long term, on high stable return, and meron siyang less trading, while tactical, it is active management. Then another risk mitigation ng portfolio is yung alignment ng risk tolerance ng investment mo sa time horizon na investment timeline ng investment mo. So, yung time horizon, ito yung period na i-hold mo yung yung asset mo as an investment, or naka-invest siya bago mo siya ibenta, parang gano'n. So, pagka mataas yung risk tolerance, it allows investors to invest in riskier asset with higher potential return. And pag mahaba yung time horizon or yung investment period, it allows investor to take on more risk as they have more time to recover from market downturns. Then once mayroon ka na-employ mo na yung iba't strategies mo to handle your portfolio and yung mga technique or strategy to mitigate risk, you can evaluate na yung performance ng portfolio mo kung maayos or kung effective mo bang in-employ yung strategy, and pati yung mitigation na risk kung maayos din ba. So, pwede mo siyang i-evaluate using benchmarking and through calculation ng return. In benchmarking, you can compare yung portfolio mo to common benchmark indices like S&P 500. So ito yung top 500 companies in US, yung Google, yung Microsoft. So pwede mo i-compare yung performance ng portfolio mo versus dyan sa benchmark na yan. Then you can also compare to bond indices. Ito naman yung various bonds indices track different types of bonds such as government bonds, corporate bonds, and municipal bonds. So ito yung mga safer or low-like investment. So if merong problem sa stock, for example, yung investment mo or yung portfolio mo, nagkaka-problem ka sa stock, and currently yung stock market is volatile, you can go in bond investment kasi mas siya, safe siyang investment if magkakaroon ng or safer alternative siya sa stock market as a stock investment. Then then you can compare naman yung portfolio mo in sector indices na benchmark. So ito naman yung mga itinatak nito yung specific sectors of economy like technology, healthcare, or financials. So for example, yung investment mo is is purely on technology industry. So pwede mo i-compare yung performance ng portfolio mo sa using sector indices para for specifically for technology industry, para ma-identify mo kung gaano ba how well performing ba yung market under that industry specifically na parang nakasegregate sa overall market. Then another way to evaluate portfolio performance is calculating yung return ng portfolio. So first is yung computing yung total return. So it represents the overall gain or loss of portfolio over a specific period, including both capital gains, which is increasing the value of the asset, and income like dividend or interest. Formula, ending value minus beginning value plus income divide beginning value times 100. Ending value, ito lang yung mismong value ng portfolio at the end of the period, then beginning at the start of the period. Then income, yun yung dividend, interest, and other income generated sa portfolio. So for example, Michael invests 10,000 in a stock portfolio. After 1 year, the value of the portfolio grows to 11,200 and he received 300 pesos in dividends.
Wala akong naririnig. May problema ba sa part ko?
Hello po.
Yun, okay. Kanina wala. Go ahead.
Sige. Wait lang po. Isasaksak ko lang po, malalabat na po para. Wait lang po.
Okay.
Saan na ba ako? So, ayun, so Sharpe ratio is it measures the portfolio's return above risk-free rate per unit of risk. A higher Sharpe ratio means better risk-adjusted performance. Formula to compute Sharpe ratio, portfolio return minus risk-free rate divides standard deviation of portfolio return. Yung risk-free rate, ito yung mga investment or funds na merong lower risk of interest rate, parang gano'n, and or default. So ang good example niyan is yung government bonds. So meron itong lower risk of interest rate. Then standard deviation of portfolio return, this represents the volatility or risk of the portfolio. For example, using yung previous example natin, Michael portfolio returned 12% last year. His treasury bond risk-free rate was 2% and his portfolio's return had a standard deviation of 10%. So, to compute yung Sharpe ratio, yung 12% na portfolio return, ililas lang yung 2% na risk-free rate, divide 10% standard deviation. So, yung Sharpe ratio ng portfolio ni Michael is 1 or 1%. So, it means his portfolio generated 1% of excess return for each unit of risk. So, in other words, for every 10% na increase ng risk, the portfolio's return ni Michael increased by 1% above ng risk-free rate niya. So, yan. Then, for Trainer ratio naman, it measures return per unit of systematic risk or beta. This ratio focuses on the portfolio's performance relative to the market risk. Higher trainer ratios are preferable as they indicate better risk-adjusted performance, taking into account only the systematic or market-related risk. So, ang pagkakaiba lang ng trainer ratio ang pagkakaiba ng Sharpe ratio and trainer ratio, yung Sharpe ratio, kinukumpit niya yung risk, yung return over the overall or the total risk, parang gano'n. Then sa trainer ratio naman, kinukumpit niya yung adjusted risk return over the market, risk, specifically sa market related risk lang. Hindi niya kino-consider yung other specific risk ng asset. So, trainer ratio formula, portfolio return minus risk-free rate divide beta. Yung beta, ito yung measures ng portfolio's volatility relative to the market. So, for example, yung portfolio ni Michael, mayroong return na 12% with the risk-free rate of 2%. But instead of standard deviation, ginamit niya yung beta to assess yung market risk. So, assume na yung portfolio niya have a beta na 1.2. So, to compute yung trainer ratio, 12% na portfolio return minus 2% na risk-free rate divide beta na 1.2. So, approximately, ang trainer ratio niya is 8.33%. So, it means yung portfolio niya nag-achieve ng 8.83% of excess return per unit of market risk naman. So that's the Sharpe and trainer. Then another key metrics in performance evaluation is computation ng alpha and beta. Yung alpha and beta measures the performance against market volatility. So in alpha, it specifically measures yung performance ng portfolio compared to benchmark index. So a positive alpha means portfolio outperformed the benchmark, while negative means underperformance. To compute the alpha, portfolio return minus risk-free rate plus beta times market return minus risk-free rate. So example, Michael portfolio earned a return of 15%. The S&P o yung benchmark niya na S&P returned 10%. The risk-free rate was 2% and his portfolio beta is 1.1. So to compute yung alpha ratio, 15% na portfolio return, iles lang dun sa iles yung risk-free rate na 2% plus 1.1 beta times 10% na market return ng S&P 500 minus 2% na risk-free rate to get yung alpha ratio na 4.2%. So it means yung portfolio ni Michael na-outperform niya yung market by with the expected return by 4.2% based on its risk level. Then for beta naman, it measures yung portfolio sensitivity to overall market movement. So, bale, in alpha, i-measure nito yung parang extra return beyond what is expected return. While sa beta, i-measure naman ito yung sensitivity percentage ng portfolio against market movement. So, bale, parang, so yun nga, sensitivity yung beta, then yung alpha is extra return mismo. So, in beta, a beta of 1 means portfolio moves in line with the market. A beta greater than 1 means it's more volatile than the market. And a beta less than 1 means it's less volatile. Formula to compute beta, covariance of portfolio and market returns divide variance of market returns. So yung covariance of portfolio and market returns, it measures how the portfolio's returns move in relation to the market returns. Then yung variance of market returns, ito naman yung measurement ng variability of market returns. So for example, yung portfolio ni Michael is sensitive to market changes. Assume covariance between his portfolio and market return is 0.18 and the variance of market return is 0.15. So let's compute yung beta. So to compute lang is i-divide lang natin yung 0.18 sa 0.01. So ang beta will be 1.2. So it means yung portfolio ni Michael is 20% more volatile than the market. So kapag yung portfolio is more volatile, usually or often nag-offer yun ng potential for greater return. So if for example, yung market is rising, yung mga portfolio na na volatile may outperform yung mga stable investment. So that's it po yung report ko. Thank you po.
Okay, so a vital aspect of bond analysis is assessing interest rate risk, no? As bond prices inversely correlate with interest rates, no? So when interest rate rise, as our presenter mentioned, bond prices typically fall, no, which can negatively affect bond portfolio value. So duration, no, a measure of bond sensitivity to interest rate changes helps in quantifying this risk, no? So portfolio management naman po, or portfolio management strategy for bonds involves selecting a mix of bonds, no, that aligns with the investor financial goals and risk tolerance, no. So investors may employ strategies like laddering barbell or laddering barbell and bullet strategies to manage risk and optimize returns. So a laddered strategy involves purchasing bonds with staggered maturities which provide a regular income stream and limit exposure to interest rate fluctuation. So the barbell strategy naman po focuses on a mix of short-term and long-term bonds aiming to combine stability and higher returns. Ito yung sigurista, no? Meanwhile, a bullet strategy consolidate maturities around a specific target date, no? Often used to time-bound goals, no, like funding a large future expense. So effective bond portfolio management also involves rebalancing the portfolio as economic condition change. So when interest rates shift, for instance, a portfolio heavy in long duration bonds may need adjusting to mitigate potential losses. Similarly, if credit risk increases for certain issuers, investor may swap, no, may swap out those bonds for higher quality alternatives to preserve capital. So portfolio managers also look at the overall diversification, blending government bonds, no, corporate bonds, and possibly international bonds to enhance the portfolio's resilience to specific market changes. So again, in essence, no, bond analysis and portfolio management are intertwined, no? Practices aim at achieving an optimal balance of income risk, capital, and capital appreciation. So a disciplined approach in analyzing bonds and constructing a diversified portfolio enables investor to withstand market volatility while pursuing financial goals. So as part of an overall investment strategy, bond portfolio management aligns with broader financial planning, offering stability and predictable returns within a well-rounded investment approach. Okay? Thank you.